All right. It is that time of the year again. Q1 of 2024 is coming to an end, and that means it is distributions time. So I wanted to give a quick update on 1054 and 1056 North Ashland, share with you a couple of the of updates over the past quarter, and make a couple of highlights of what to expect in the coming months as well. First topic I'll probably get into is K1s. Tax season is upon us. I had many anxious investors awaiting K1s to wrap up their tax filings, myself included. You should have seen an email where those just came out and were distributed. So, good news, those are in your inboxes, and hopefully, you had a chance to crack those open and get them over to your accountants for your own tax preparation purposes. So, glad to have that out of the way. If there's any questions, feel free to reach out, and happy to answer any questions that I can. Otherwise, we are well underway on that front. Outside of that, one of the things I would highlight that you would expect to see on your K1s is the depreciation loss against the income on the property. And you'd probably see a pretty large number coming through on the K1s. Part of what I wanted to share with you is one of the things we did this year, and I'm actually going to pull it up here, is what's called a cost segregation study. What this is essentially a study done on the property where we actually have an engineer come out. Now we have to pay something like $2,000 for this report. You can see this one is something like 24 pages long. And essentially what this is an engineer comes out, assesses the property, and under the IRS tax code, they're actually able to accelerate depreciation. And so with these types of investments in real estate, typically you have a straight line depreciation where it's 1/27 and a half years. And that's essentially a paper loss that you're able to write off on your taxes as a function of holding the asset, partly due to the fact that it is a depreciating asset. It requires some level of investment to keep the asset in good operating and working order. And as such, the tax code allows for this and it enables you to take a what's called the depreciation expense or a tax loss. With this study in particular, what they do is they essentially look at all of the components of the building and they actually break it down. So rather than doing a straight line 27 and a half year depreciation schedule, they actually look at the things that might be on a 5-year schedule, 15-year schedule, so on and so forth. And what the tax code allows you to do is essentially accelerate some portion of that. I'm not going to go through this whole document. If any of you are interested in seeing what this looks like, I'm happy to share it. But I will jump forward to a couple things. This is probably the best way to look at this. They essentially subdivided the value and then they allocate some portion of the asset on varying schedules. So some portion is on a 27 and a half year, which is what you normally get. And then with this study, you get some allocation to 15-year, 7-year, and a 5-year. And what bonus depreciation allows you to do is essentially take anything that's in, I believe, 5, 7, and 15 and accelerate that. And so what that would mean is on, let's say, roughly $1 million asset, if you're going to do a straight line depreciation, 1/27 and a half is roughly $36,000 that you'd be writing off against the asset on an annual basis. But with this, you can see there's a very large distribution allocated to the 5-year bucket. And what this means is we essentially get to accelerate. This is, call it $200,000 in write off in the first year. Now, that's not the entire story to the math. I think it's something actually like 80% of that value this year. This in 2024, it'll actually be, I think, 60% based on the tax code. But what this means is rather than, in aggregate across all of the investors just taking a straight line depreciation of 36 grand, we essentially get to take $200,000 and distribute that on a pro rata basis back to all the investors. And so you would see this actually in your K1 as a net loss on your income. And what this does for you is essentially offset the income that you'd be receiving through, the distributions and payouts. So net, this is a really good thing. It passes on paper losses to the investors. And, depending on your circumstances and your own filings, this would have, implications in a very good way in terms of offsetting income that you'd be filing for taxes. So definitely something to discuss with your accountant if you have questions on that, but wanted to share that piece with you. But you can see they go through a pretty comprehensive evaluation of this. They give all the breakdowns, so on and so forth, basically everything. And you can tell they get down to things like wood and paint and tiles, and they essentially look at all of the component parts and what they believe it should actually be depreciated against. So that's one thing you'd be seeing, and something we will continue to do as we look to do new investments. Is a very beneficial strategy for investors overall. Other things. So overall, pretty busy quarter, I would say. For my last update, which was only really just a month or two ago, I gave some highlights on some of the other things that have been going on. Namely, we had a huge roof replacement that we had to do on one of the buildings. I'll quickly show some of the photos here from that, which I shared, I think, last time as well. On one of the buildings, we actually did a complete gut roof replacement. So that means we got down to the wood of the actual roof. You can see in some photos over here where it was actually pretty deteriorated. They tore up a lot of that, replaced a lot of the substrate there, and installed a completely new roof, which ended up looking something like this. So yes, very clean, shiny. They rebuilt some of these walls. They took out a section here in the front of the building and made sure we have a very good, long lasting roof here. Net it's cost us probably about 40, a little over 40 grand to do, but I think it was much needed. When we first went through the inspections, we saw there was a number of issues, not only with the roof, but also with some of the masonry, where you can see they actually, in some examples, tore down some of the walls and had to rebuild them as a result. I think this is probably a good example. So yeah, a ton of deterioration where over the years, this just wasn't properly maintained. So unfortunate that we had such a capital expense, but it was in our expectations, in our budget, probably happened sooner than we were hoping for. But nonetheless, we now have a roof that will last years. And when we go to sell this, that will make things much smoother on that front and make for a cleaner transaction at the end of the day. In addition to this, we also, since we already had these guys out there, we had them look at the roof of the other building and they did some routine maintenance. I think we spent maybe another 35 or 4 grand to make sure that was in good working order. We did have some complaints of a couple of leaks in the commercial storefront there, and wanted to make sure we mitigated those as well. So I would say net, the roofs are in good working order. We took care of all the issues that would need to be taken care of, and hopefully this will not be an issue anytime in our lifetime of owning this building in the near future. So one of the other things we had to navigate in this last quarter was actually turning over one of our commercial tenants. Initially, we are expecting that the nail salon in the larger storefront, they have an entire first floor of 1054. Their lease was coming due this coming July. And it just so happened that through a friend of a friend, we knew somebody else that was looking for a salon space, and they asked for us to reach out to the current tenants to see what their plans were. Well, it turns out they're shutting down their business and we're planning to not renew the lease. This was somewhat unexpected because typically you have like a 5-year term and then there's an option to renew, and a lot of times they just renew. So somewhat unexpectedly, I found myself in a heated commercial lease negotiation with a new potential tenant. Overall, I think we got a great deal. These spaces typically can be very difficult to lease up. It's very different than typical residential retail. Oftentimes, if you're bringing in a broker, you're going to pay them 5% of the contract value. So imagine this lease is something like, $3,700 a month. Multiply that by 12, multiply that by 5. If you're doing a 5-year term, you're going to pay a commercial broker roughly 5% of that contract value. So assume that contract value is something to the tune of 220,000 plus. You're going to pay 5% of that to the broker just to get that deal done. In addition to that, commercial tenants are often looking for things like build out concessions where the owner is actually paying to essentially put in new flooring, paint the place, update the lighting, et cetera, et cetera. They also are typically looking for rent abatement because a lot of times when a new business comes in, it's going to take them, several months to sort of get in place, get up and running, and make sure the business is in good working order. Now, on one hand, you would expect that commercial units are going to turn over. Ideally, they happen much later into the life after the business has been operating for some period of time. The building itself has been operating for some time. But here we are, just a number of months, not even a full year into ownership, and we have a commercial unit turning over on us. That said, we did get into an active negotiation. They were very interested. They had been looking around for quite some time, and we had sort of the mutual relationship already in place, and so that kind of helped things along. Initially, when we started these discussions, my first step was really to look around the market, see what else was available in the area, and start to try to price what I think the commercial unit should be going for. Everything I looked at, I would say would be anywhere from, $29 a square foot per year, which is a weird way of pricing these, but that's how it goes in commercial, up until probably, $32 a square foot, even higher than that for like really prime locations. What that translates into is, figure, call it $30 a square foot in rent per year times however many square foot the unit is in. Now, the challenge of this is the lease negotiations are always very different. In some cases, the owner's paying for everything. The tenant doesn't pay for anything other than just rent and their own utilities. In other cases, you have what's called a triple net lease where the tenant is actually paying for all of the expenses. So they pay a pro rata share of water. They pay a portion of the real estate taxes. And then a lot of times they pay for all of their own maintenance and upkeep of the building. That's pretty uncommon for these mixed use commercial type situations. And so going into the negotiation, we kind of fought and took it from all angles. We essentially proposed two options, one being the triple net approach, one being what's called a modified gross lease approach, where we offered them, I would say on the low end of the market rate rents, we offered them no build out concessions and 1 month of rent abatement, where we would give them a month free of rent for them to kind of get up and running. Their counter to that was something like $24 a square foot. I was coming in at 29, and they wanted something like 3 to 6 months of rent abatement, and they wanted build out concessions. After much back and forth, we eventually landed on $27 a square foot. We are including one parking space, and we are giving them 2.5 months of rent abatements as opposed to the 3 that they were really trying to push for. I think it's a great deal for us. At the end of the day, the prior tenant was paying $3,700 a month. They also had 2 parking spots included. In this new lease, they're essentially going to be paying $3,600 a month, but only one parking space included. I suspect we'll be able to rent that other parking space for about 150. So I think net on the whole, we're even in terms of rental income that we would be getting from that commercial space. The hit we will be taking is the 2.5 months of rent abatement. So that comes out to be something like 9 grand of income we will not be collecting. But that being said, we do have expectations around what I would call sort of vacancy rates. So here's a snapshot of the lease. We locked them in at 3,600. The other nice piece of this structure is that these guys are going to be locked in for 5 years. They'll have an option to renew for another 5 years. And there's a built-in 3% increase in the base monthly rent on an annual basis. So there's no negotiation to be had there. Every year, this steps up by 3%. And as I mentioned, we'll be including one parking space. We will be responsible, and this was the case before, we're responsible for all the water utilities, real estate taxes. So none of that changes. And then they're responsible for their own utilities, electric and gas. And then any repairs and maintenance as ownership, we will be responsible for. One thing I will highlight, so this is actually our initial projections on the building. There's a lot going on here, but this is what we built into our expectations around vacancy. And so you can see we had reserves essentially built into our budget of about 13 grand in any given year. We'll be taking about 9,000 in economic loss. However, that was roughly $4,000 in anything else. So think unit turns or anything else that we'll be facing for the remainder of the year. Outside of that, I would say lease ups are going really well. We do have, I think, 2 units actively right now. Their leases are coming due at the end of April, one of which will for sure be moving out. The other one, we're in active negotiation on renewing their lease, or they're actually contemplating moving into the slightly cheaper unit just above them, and then we would look to fill their units with a new tenant at market rate. So I would say overall, things are moving according to plan. We're getting rents up to what our targets are, and we're moving things along. So I think once we get past April, lock in these final leases, we'll be in a really steady state coming into Q2 of this year. In addition to that, the Airbnb is still doing really strong. January, February are always really weak, but I think as I said in my last update, once we start getting into this time period, March, April, May, June, things start to pick up quite a bit. And we actually just signed a 1 month contract for $3,500 for one of the 2-bed units. Typically, that unit is renting for, call it $2,000 a month. So, well over a 50% increase for that 1 month rent. And then the months to follow will kind of move back into either midterm leases or Airbnb kind of short-term type leases. Last thing to touch on. So we do have some additional CapEx coming up. If you guys remember, we did some plumbing repairs to the basement of 1056. 1054 faces some of the same issues where essentially we're going to have to dig out some of the concrete in the basement and replace some of the piping to ensure that the flow and the P traps and everything is in good working order, and to ensure that essentially sewer gases aren't coming back into the building. When you go into the commercial unit, you can actually smell a bit of this. And so this is one of the things we're going to have to address here in the next several weeks. So with all of that, we are sending out distributions today. I already have everything staged. We will be taking a conservative approach for this distribution. So our preferred return rate on this deal is 6%. We're going to send out roughly 6 to 7% annualized return. So we'll essentially just meet the preferred return for all of the limited partners. The reason we're going to do that is to ensure that we have enough capital reserves as we sort of start to navigate not only this new commercial tenant coming in, but a couple other CapEx expenses that are upcoming, especially on the back of just allocating, $40,000 for a new roof replacement. So that'll give us some time to continue to build up reserves over the next couple of months as we get into the Q2 distributions. Outside of that, I think that's all I have in terms of updates. All things considered, I would say things are going relatively smoothly. It's been definitely a crazy couple months, but we managed to navigate it, I think, pretty well. And definitely getting the commercial unit on a new lease for a 5-year term with what I believe to be a good operator with a strong book of business. I feel really good about knocking out some of these big CapEx items. I think will be good. I would not anticipate many more in the near future. And so once all that settles down, we'll make sure our operating accounts get back to a really strong level and continue to execute the plan and make sure this building is running smoothly. So as always, if you have any questions, feel free to reach out. Otherwise, thanks for the time, and we'll talk on the next update.